Dan Ives of Wedbush remaining bullish on Nvidia, writing, Nvidia is the indisputable Rocky Balboa champion of the AI revolution, and that is not changing anytime soon on the chip front. Pleased to say that Dan joins us now. Dan, great to see you.
Great to be here.
Okay, I want to ask about the post, because you had that post of them saying, like, congrats, Google, but we're better. They also responded to Michael Burry's takedown of the depreciation thing. It kind of gives a feeling that, like, Nvidia cares about the fact that their share price is falling, and they're trying to fight back against it. What do you make of this sort of PR push they're doing?
Yeah, so I view it a little differently. Look, I mean, at the end of the day, like, there's one godfather of AI, and that's Jensen. I think Jensen, right now, it's the recognition that they're transparent. In other words, like, NVIDIA is not trying to hide anything. They're ultimately saying, like, hey, we are out there front and center, and it just comes down to demand and supply is 12-1 for their chips. I mean, I saw that being in Asia for the last 3 weeks. So them congratulating Google, AMD, and others that are going to be successful, it continues to be NVIDIA's world, and everyone else is paying rent. But the reality is that they are not going to sit there and hide behind some PR when it comes to, you know, whether it's Burry or anyone else calling it a bubble. I mean, Jensen's going to be out there front and center because, in my opinion, it continues to only be 10:30 p.m. in that AI party that goes to 4 a.m.
But, you know, this makes me think a lot of Intel. Back in the day when we were all rushing out to get the 386 and then the 486 and maybe the Pentium, right? But then Apple was like, why are we giving them these margins? Let's make our own chips. And so did everyone else. And now Intel obviously needs a sort of government bailout in the form of a stake purchase. Why isn't NVIDIA vulnerable to the same kind of, you know, vertical integration at these, if Meta, if Google, if Amazon all make their own chips, as they are doing?
It's a great point, and I get the comparison. They're 4 years ahead, in my opinion, of really anyone else in the world, including Huawei, right? So it comes down to, like, now will there be a gap narrow? Big tech's going to continue. They're going to go and make their chip. You'll see that they'll vertically have that ecosystem, and that's a great thing. Because the reality right now is like 12-1, demand and supply. In other words, NVIDIA doesn't have enough chips to ultimately meet demand, right, relative to what we see. But it speaks to my point. It's about the second, third, fourth derivatives of AI playing out. You have 3 to 4 trillion that's going to be spent in the next few years. To call this a bubble, it's wrong. As someone like myself that covered tech stocks in the late 90s, it's a 1996 moment, not a 1999 tech bubble moment. That continues to be our view.
How does that 3 to 4 trillion of spending get funded? Famously, Sam Altman was asked on stage a couple of weeks ago how he's going to fund his $1.4 trillion in capex plans with only $13 billion in revenue, and he just got so angry that he declined to answer the question, right? I see that, you know, ChatGPT has, right now, I think, they have a $20 charge, right, for the account that I pay double because I have a work and a personal account. But they're not making massive amounts of revenue. 35 million people are signed on, and it could turn out to be like the Friendster or even maybe the MySpace of AI. Where does this revenue come from?
Yeah, well, see, look, today, it's still enterprise. You know, like, when we think about the enterprise, only 3% of companies have gone down the AI path. So when you look and that's just in the US. Globally, that's just actually starting with sovereigns, what we're seeing in Asia. So when I look at OpenAI, I view it as, it's not just going to be a ChatGPT. It's about what that's going to be on the enterprise, consumer. The consumer applications haven't even started relative to Apple.
But it has to come quick, right? I mean, remember when the dot-com bubble burst, it took years and years to make up the revenue that we needed to pay for the fiber outlay in the beginning.
Yeah, and I think for OpenAI, for every dollar that they're spending in terms of the stakes that they're taking, they're, just like NVIDIA, they'll get $12, $15, $20 back in terms of revenue.
If we're, though, talking about who wins the enterprise race, I mean, wouldn't that be Google, though? They already have relationships with 40,000 companies. And then when it comes to consumers, They know that name so much better. I mean, increasingly, obviously, they know about OpenAI and Sam Altman and ChatGPT, but especially with that enterprise relationship, who's to say that OpenAI wins out on that horse race?
Look, I think there's going to be many winners, right? I mean, from Nvidia on the chip side, when you talk about Microsoft, where they stay on the hyperscale, Oracle, and I think that stock's been way oversold here. But look, the reality is, you go back earlier this year, the New York City cab driver was bearish on Google. Now look at it, because it's my view, it's not just on enterprise with GCP, with Google Cloud, with what's happening on chips along with Broadcom, but also, you look out, they're going to ultimately have that Apple deal. I mean, Apple is going to have to bet on Gemini as their AI partnership, which is another benefit here. So I think it just speaks to our view is that, it's not just about Nvidia. And I believe Nvidia ultimately is a stock that goes much higher here, 225, 250. But it's about the second, third, fourth derivatives playing out across, I think the world. And for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
So Nvidia at the lowest in the month, is this just like the most incredible buying opportunity that we're going to see for this company?
Every time this sells off, you own it, because it's my view, it's $5 trillion and ultimately it's $6 trillion. Because look, there's only one godfather, right? And that's Jensen. And there's one chip in the world fueling the AI revolution. And that continues to be Nvidia. There will be other, anytime if there's a DeepSeek moment, you'll have Google TPU. There's going to be other things that happen, but nothing is going to get what I view as really this Rocky Balboa of the AI revolution, which is, Jensen and Nvidia.
As the semiconductor market heats up, Bank of America's analysts reaffirmed their buy recommendation on Nvidia, citing the company's strong earnings into the upcoming year and pointing to the ongoing need for AI processors, cloud infrastructure, and cybersecurity solutions. The announcement came after it was revealed that Meta Platforms is considering using Alphabet's tensor processing units in addition to Nvidia GPUs, a move that would change the market for AI technology. BUFA maintained its buy recommendation, but cautioned that as hyperscalers diversify their compute strategies, competition and short-term volatility may increase. According to analysts, if Meta rents TPUs next year, it would attract a significant amount of GPU demand and drive down prices throughout the entire supply chain. This might be advantageous for Broadcom as it boosts short-term TPU manufacture, and Google raises its investments in TPU manufacturing. According to sources, Meta Platforms is thinking about powering its AI data centers using Google's tensor processing units. Historically, Meta's artificial intelligence infrastructure has been powered almost entirely by Nvidia CPUs. But according to the reports, it is now thinking of switching to Google by the beginning of 2027. Nvidia shares are already down roughly 18% from their year-to-date high, which was reached in late October following yesterday's fall. Rising rivalry in AI hardware is shown by Meta Platforms' possible switch to Google's bespoke chips. Losing Meta's business by 2027 could be a significant setback to Nvidia's top-line growth, as the company has been the leading provider of GPUs for extensive AI training. Who's to say that other companies, like Microsoft, won't do the same? The information story basically reminds us that if hyperscalers began diversifying their supply chains away from Nvidia's chips, the company's remarkable success might come under close examination. The multinational's pricing power and market dominance may be undermined by such a structural change, making it more difficult for Nvidia's stock to repeat its superior performance in the years to come. Jim Cramer, a former hedge fund manager, continues to advise long-term investors to start or increase their holdings in Nvidia stock in light of the company's recent decline. He claims that the market's response to the Meta news ignores Nvidia's solid foundation, especially the company's ability to see demand worth an astounding $500 billion. Cramer stated in a recent CNBC broadcast that the demand is insatiable for Nvidia's Blackwell chips and its upcoming Vera Rubin platform, which he predicts will push the company's stock to all-time highs in 2026. With a price target of $235 and a potential upside of just under 40% from here, TD Cowen analysts also reaffirmed their buy rating on the AI company today. For the upcoming year, other Wall Street firms also advise holding on to Nvidia stock. With a mean target of almost $253, which represents nearly 50% upside from current levels, the average recommendation for Nvidia shares is still strong buy. For training and executing sophisticated AI models, Nvidia's graphics processing units, GPUs, have been the preferred hardware. The company's high-end processors have given it a competitive edge that has enabled it to set incredible prices and achieve record-breaking earnings growth. Other computer behemoths have, of course, also been keen to lessen their dependency on Nvidia's technology. Alphabet, Microsoft, Meta Platforms, and Amazon are among the cloud hyperscalers that have been developing their own processors that can manage workloads that are now dominated by Nvidia's GPUs. According to reports, executives at Alphabet's Google Cloud business have calculated that the company could earn about 10% of Nvidia's yearly revenue by increasing direct sales of its TPUs to third-party clients. It's also likely that changing competitive dynamics would significantly strain the GPU leader's profit margins if Alphabet's TPUs was able to overtake Nvidia in market share at that level. Although Nvidia's business has always been prone to cyclical tendencies, the company has experienced phenomenal growth over the past 5 years due to the rising demand for processors that power AI data centers. Although hardware companies often face increasing competition and commoditization tendencies over time, Nvidia has been able to defy gravity in terms of margins thanks to the performance advantages provided by its chips. For comparison, last quarter's gross margin for Nvidia was 73.4%. Although the level was lower than the gross margin of 74.6% observed in the previous year, it is still an excellent margin for a company that specializes in hardware. Although it was well known that cloud giants were developing their own AI processors, rumors that Meta Platforms plans to purchase Alphabet's TPUs may indicate that Nvidia's competitors' technology may be ready for prime time sooner than investors had expected. Meta Platforms and other clients will not immediately abandon Nvidia's processors due to the adoption of Alphabet's TPUs. Rather, cloud giants will probably try to move some of their processing requirements to in-house chips and other processors that can provide more economical performance. The AI processing market is currently expanding at a rate strong enough to sustain several winners. Nevertheless, Nvidia's growth story is seriously threatened by the emergence of bespoke chips and processing alternatives created by some of its largest clients. The technological environment is being significantly impacted by developments in the field of artificial intelligence, AI. These state-of-the-art algorithms' capacity to automate monotonous operations, optimize workflows, and produce unique content is increasing productivity, saving time, and releasing users for higher-value work. Nvidia has unquestionably benefited from the AI revolution. The business invented the graphics processing units, GPUs, which are now the industry standard for AI, and supply the processing power required to operate these cutting-edge generative AI systems. Nvidia's revenues and profits have skyrocketed due to the demand for these chips, which has also raised the company's stock price. But according to rumors, Alphabet has fired a shot across Nvidia's bow because it wants a piece of the action. This week, it was reported that Meta Platforms and Alphabet are in negotiations to install Google's tensor processing units, TPUs, in its data centers so that AI models can be run there as early as 2027. In order to support its own cloud computing operations, Google started developing these specialized processors in 2018. Over the years, the company has released a number of improvements to the TPUs, which have since been modified to support AI. These processors have only ever been utilized in Google's own data centers. The business has never sold them. But according to recent sources, Google is thinking of selling TPUs to Meta. If this is accurate, it would represent a dramatic change in the company's approach and could be problematic for Nvidia. The main winner of the AI revolution has been Nvidia. This is partly because of its GPU's widespread appeal. These chips offer a clear advantage over many of Nvidia's competitors in addition to being undoubtedly the gold standard for AI computing. The company's CUDA architecture, a collection of software tools, was created years ago to enable developers to use GPU's raw, number-crunching power in their own computationally demanding applications. This rapid processing has a price because AI's enormous computational requirements often result in significant energy consumption. Google's TPUs, on the other hand, were made to be more specialized and energy efficient than GPUs. Google has so far kept these specialized processors to itself, but as the AI revolution unfolds, the business might be changing course. The stakes are billions of dollars. It might just be a matter of money, which is why Google is thinking about changing its approach. To position themselves to benefit from the widespread use of AI, many tech businesses have been spending billions of dollars on capital expenditures, capex, and this spending is only growing. Alphabet intends to increase its capital expenditures from $52 billion in 2024 to $92 billion in 2025. Amazon has increased its spending from $83 billion to $125 billion. Meta intends to increase its spending from $37 billion to over $71 billion. Microsoft is anticipated to increase its spending from $65 billion in fiscal 2025 to $94 billion in fiscal 2026. The statistics may rise because the year is not yet ended. The stakes are huge, as evidenced by the fact that big tech is projected to invest up to $405 billion on AI capital expenditures in 2025. Google might improve its own performance at Nvidia's expense if it were to receive even a small portion of that expenditure. It's crucial to put the news of Google's potential strategy change in perspective, even though it has significant ramifications. Although Nvidia doesn't provide any precise information on its largest clients, Wall Street has done some research, and it's generally accepted that Alphabet, Amazon, Meta, and Microsoft are on the list. Alphabet is still Nvidia's largest client, even though it has been creating and operating its own TPUs since 2018. As a result, Google still need Nvidia GPUs in addition to its own TPUs to achieve the speed and energy efficiency required to compete. It also implies that Nvidia will remain the leading company in the data center GPU market even if the rumors are accurate and Google's power-hungry chips reduce Nvidia's revenue. According to IoT Analytics, Nvidia now holds a 92% market share in the data center GPU industry. Nvidia is well positioned to continue reaping the benefits of the secular tailwinds of AI, even if Google is successful in gaining some market share. According to Jensen Huang of Nvidia, spending on AI infrastructure might total $4 trillion in the next years. There is a high demand for capacity to handle AI workloads, according to tech heavyweights like Oracle. In recent years, investors have flocked to invest in artificial intelligence, AI equities, across a wide range of industries, including software firms and chip designers. Over time, businesses creating or utilizing AI have represented and still represent potential winners. This is due to the fact that AI is assisting businesses, organizations, and even individuals in being more inventive and productive. Additionally, all of this might greatly increase the profits of those participating in this revolution. However, one specific area of AI has just come to light as potentially offering a significant opportunity. I am referring about AI infrastructure. This includes the platforms used to create and progress AI initiatives, such as processors and networking hardware, for instance, as well as data centers. Both cloud service providers and private businesses with significant AI plans, like Tesla and Meta platforms, make investments in these. Is investing in AI infrastructure the next big thing for investors? Let's investigate. Let's start with some background information on the AI story thus far. Since governments and businesses have realized how AI can accelerate new initiatives and streamline procedures, many have looked to businesses that could assist them in achieving these objectives. They have implemented speech AI technology or AI-driven software to instantly increase productivity and save costs, or they have looked to cloud service providers for access to AI chips to execute workloads. Many businesses have seen an increase in income as well as share prices as a result of this. This momentum has helped the benchmark soar higher, even setting many new records this year, because several of these players are heavily weighted in the S&P 500. Let's now examine our query on the cost of AI infrastructure. Is this the next rush for gold? It goes without saying that investors are constantly searching for the next big opportunity that might boost company values and earnings. This could be a topic, like the weight loss medications of today, or a technology like internet-related businesses in the late 1990s. Eli Lilly, the massive weight loss medication company, has enjoyed double-digit revenue growth and a roughly 200% increase in stock price in just 3 years. Spending on AI infrastructure is undoubtedly set to be a major theme in the coming years for the following reasons. Capacity for AI workloads is currently one of the most important requirements, and in certain situations, clients must fight to obtain it. Earlier this year, Oracle said that a single customer requested all of the capacity, regardless of its location. Cloud service providers and businesses using AI internally will need to invest in infrastructure going forward in order to satisfy client demand. According to Jensen Huang, the CEO of Nvidia, the company anticipates investing between $3 trillion and $4 trillion on AI infrastructure by 2030, indicating that this may be a key issue in the years to come. Which businesses stand to gain? As businesses turn to Nvidia, Broadcom, and other chip and equipment suppliers for the items they need to develop and build out data centers, their revenue should increase. In addition, cloud providers should continue to enjoy high demand for their goods and services even as they invest throughout this stage. Ultimately, they are investing because they perceive a significant commercial potential that is now developing. They are therefore in a good position to start reaping the benefits right away as they spend. All of this implies that investing in AI infrastructure might be the next big thing for investors. However, before you fully embrace this subject, it's crucial to remember a few critical facts, despite the fact that this is an exciting chance. Yes, AI infrastructure appears promising, but there is some risk associated. Any delay in the build-out or economic downturn might have an impact on the company's development and share prices. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.